Hi everyone, welcome to today's webinar. We're going to get started right on time and get into this conversation we're going to be having today with these panelists. Before we do, a few housekeeping items from me. So first off, my name's Rachel Whitehead. I'm VP Marketing here at ChartMogul. And I am super excited for this discussion we have today. We're going to be focused on growth strategies in 2023. And so this is the final on our panel series that we've been running so far this year. We've covered investor reporting, we've talked about churn mitigation, and we have links to those discussions live on our blog, which you can read if you've missed those. But otherwise, this will be our final panel for the year. We'll be coming back in February talking about the evolution of PLG into product-led sales. So keep an eye out for that one. But for today, we're going to be focused on growth strategy. And I'm super happy to be joined by a panel of experts here who have a lot of firsthand experience driving this in their own organizations. And so to introduce them, starting with Jonah Remz, maybe you can give a little wave. Jonah is VP Finance at financing solution Capchase, and today he's joining us from New York. At Capchase, he's leading strategic finance, FP&A, and financial operations for that business, and is really heavily involved in deciding how to grow for next year. Next up, we have Daria Danilina, co-founder at Salesroom, which is a video conferencing app designed specifically for salespeople. Daria joins us from London, and prior to starting Salesroom last year, Daria was part of the growth stage venture capital firm Ox. And then finally, we have Dirk Sahlmer, who's an M&A manager at the SaaS portfolio company SaaS.group, and Dirk's joining us from Cologne. And in his role, Dirk is identifying high potential bootstrap businesses and then really helps to provide a new long-term home for them to take their product to the next level. So you can see we have a real wealth of experience here on the panel today, and I think we'll get into some really good discussions. But maybe to warm us up a little bit with thinking about next year, I thought we'd have a bit of a moment to make some big predictions. So a question to the panel here for your big lofty prediction. What big tech company do you think is going to outperform their growth projections in 2023? Anyone want to volunteer to go first?
I'm happy to kick us off. It's a bit of a standard, one would say boring guess, but for me, it's Microsoft. I think, and here's the controversial bit, I think they're doing a lot of very innovative things. Like people slam them for copying Slack, for copying Canva. But if you think about their AI strategy, everything they're doing with GPT-3, it's truly market leading stuff. And I think that, yes, at the end of the day, they're doing it so that more people buy cloud from them. But I think it's an interesting strategy that the market is not giving them enough credit for.
Nice, Daria. All right. Jonah, what about you?
And this is not constituting investment advice. Disclaimer.
We should put a disclaimer, actually. But yeah.
Doubling down on that. Definitely not a public markets expert, but what I would say is Snowflake. So what I like about Snowflake is I think in this environment where we're seeing a lot of companies look at areas where they can cut back, and whether that's on cost per seat licensing and whatnot, Snowflake, in terms of their just data infrastructure, the way that they've had really strong retention numbers, continually expanding their TAM, and then also just with them having recently revised guidance, and they have a history of always being able to really deliver on what they've kind of said to the market. I think that's a company that certainly is a prospect to outperform.
Nice. All right. And Dirk, what about you?
It's really interesting because you just destroyed my number one and my number two, so I now have to switch twice. To be honest, really, I can show it to you. My first one was Microsoft. My second one was Snowflake. Snowflake, just because of the high NDR, so they have like outstanding net dollar retention, great metrics. I think they are also pretty cash efficient. And yeah, I mean, Microsoft, no doubt about that. Market share, pretty dominant, and yeah, all the things that Daria just mentioned. I would also add GitLab maybe. It fits into that Snowflake bucket because they also have outstanding NDR and have a very sticky product. So I think mission critical products that are pretty sticky, and have really high NDR, they could just stop user acquisition and still would continue to grow. And so I think these companies are set for this current market trend. And so maybe I would add GitLab as my third one.
Awesome. I love the combination here. And it sounds like the dream team, I think, in terms of growth for next year. We'll come back to this forum in 12 months' time and see where it ended up. But for now, today we're going to be mainly talking about smaller companies, obviously private companies, pre-public, but also those that are more in the growth stage. So really sort of focusing on SaaS. And I thought, what better way to start off the discussion than actually speaking to some of the firsthand experience here that we have in the room. As a VP marketing, there's a lot of talk in the industry at the moment that I'm hearing around 2023 really being focused on growth efficiency and, of course, sort of hardcore execution. And so I'm interested to hear sort of if that holds true for the three of you representing sort of different types of growth. So maybe let's start with you, Daria, because Salesroom is just over a year old, right? And you raised an 8.5 million seed round earlier this year. So what are you prioritizing in your growth strategy for Salesroom next year?
So we've been in the market for about 8 months, but the company existed so a bit more than a year, so a year and a half. For me, the right goal for next year is to find the right type of customers quickly. And I'm going to unpack that. So the right type of customers, I think, again, kind of speaking about fundraising, not every dollar is created equal, especially in the venture world. And one is, as Dirk said before, a retained dollar is worth a lot more than a newly acquired dollar that has yet to renew. But I also think that for better or worse, who those dollars come from matters a lot for venture investors. Like if they see you're only used by early stage venture companies, it's not as strong a signal as if you're used by more established companies that could have any kind of tool in the world, but they choose to work with you. And the other kind of side of the coin is we are building something that truly, I believe, doesn't really exist. There's Teams, there's Meet, there's Zoom. There isn't the vertical video as such, hasn't quite happened yet. And we're working very hard to make that happen. So I want to be working with people who are super at the forefront of where sales is going, because I know that their feedback and their feature requests in the end of the day are what's going to allow us to build the market leading product. So that's the right type of customer. Quickly means that if you get to the people, and it's just, I think long sales cycles kill companies. In good times and in bad times, the longer it sort of protracts, I think your chances of closing that account go down and down and down. So I think landing the right decision maker and then figuring out processes that will allow us to get to those right customers quicker is key next year.
All right. So big focuses for sure. And definitely, I think there's that kind of counterbalance is what you said about the right type of customer, the right dollar that you're hunting for, and then making sure that's coming in quickly, which is a nice kind of counterbalance. Maybe over to you, Jonah, since Capchase is hunting sort of a different type of growth. You've been around a wee while longer, and then you raised an 80 million Series B in March, right? So what are you optimizing for at Capchase next year?
Yeah, so I think we've definitely kind of in the first phase of identifying that product market fit. We're now in sort of that next phase where it's really around optimizing for scalable growth. So we really kind of work hard to ensure that all teams can have a structure that can support multiple turns of the business as it stands today. So that's in terms of volume, spend levels, headcount, and that it's not just a linear fashion, but it's really one that we can put multiples on the business and really have the structure that supports that. So that includes, for example, lowering customer acquisition costs across all the different deal channels and making sure that we really know where to, let's call it, pour the gasoline on the fire. And, kind of earlier in the business, I would say it was a bit more of that hustle phase where it was a little all hands on deck to really make sure that we had that product market fit. Now it's around how can we specialize and how can we really think about growth from that different areas that we can invest, and how can we constantly look at metrics to make those calculated decisions. I think we're also, as we continue to grow and we have the opportunities at our disposal, I think it's about optionality. So we're always looking at Capchase, from all the data that we collect, how can we best serve our customers, and opportunistically looking at product and development efforts to take that data and serve it back to the customers is something that's really important for us as we think about that kind of next phase of growth.
And so I wonder, like, Dirk, from your perspective, we've sort of seen the sort of seed stage focus, the sort of scale stage focus. What about for some of your portfolio companies, which tend to be more sort of bootstraps, right? So what are they optimizing for? What are they focusing on when it comes to growth for next year?
Yeah, so I mean, we are in a comfortable situation because we are focused on acquiring profitable companies, cash flow positive companies. And so all of the companies have a certain safety margin and are not, they are not in a hurry to react to the current market conditions. But still, we are working on some strategies to overcome the current trends. And given our portfolio consists mainly of pure PLG products, so low touch, self-service products, they have a more than average churn. And so we are trying to work on churn reduction. We are trying to increase ACV by selling to higher tier accounts. So we are going a bit more upmarket in the enterprise tier, because before we already got certain leads from enterprise clients, but we were not able to serve them just because our setup was so lean. And so we are now trying to build up more sales expertise internally, trying to tackle higher ACV clients, which means, as I said, moving up market. Then we're also trying to convince clients to buy more annual contracts, so pay upfront, maybe giving them a higher discount, but then you have more predictable revenues, and also to lock them in for a certain period. And then we're also trying to work on features that really relieve customers from pain, rather than just providing benefits, to also create upselling opportunities for existing clients, because as Daria said, getting a dollar from existing clients is cheaper than getting a dollar from new clients. And so these are like the things we're working on.
Yeah, absolutely. And it's interesting because, like, with some of the changing dynamics that we're seeing in the market at the moment, a lot of the kind of strategies that you've all mentioned right now, they're not crazy different from some of the things that have been happening over the last few years. And so sort of a question to everyone is, what's changing in terms of the sort of growth at all cost mentality? Is that evolving, and are you seeing that have an impact on sort of how you're approaching your growth strategy for next year?
I mean, absolutely. I can speak for go-to-market orgs, because that's who I speak with on a daily basis. And so I think the thing that sticks to me is, if you, let's say last year, right, you in January, the org gets a number. That's what you need to hit for the year. And that number then gets kind of worked down onto what does it mean for each individual AE, what does it mean to each individual SDR. And let's say, just for the sake of an example, an SDR needs to bring 10 opportunities a week. And that would be a very efficient SDR, but let's just assume that. And so let's say the same SDR, they only managed to bring 5. So what people used to do, they were like, all right, that person only manages 5. Let's hire another person to make up for the other 5. But they wouldn't kind of, they wouldn't train or think about the process differently. They would basically keep throwing people at the problem. Wow. And this is kind of the interesting thing to me, is like, we look at things like quota. If you look at quota attainment over time, the numbers are pretty stable for the last, 5-6 years. It's how we relate to those numbers that's changing. It's, oh my God, 50% of my salespeople are not hitting quota. Well, I clearly need more people and lower the quotas down, versus like, let me optimize the team a little bit. And what I see in the market for sure is that now when your people are not hitting quota, it's becoming a real issue. And people are thinking a lot more around optimizing their existing team, making the most with what they have, making sure that people are enabled, they're coached, they get that rep productivity up. And yeah, instead of kind of blindly throwing more people at the problem.
Mm-hmm.
Yeah, I like that. I think piggybacking off of that, you know, the important thing is that there's growth, which in the past it's been, as you mentioned, the growth at all costs, and then there's how can we grow to create something that's sustainable. And I always think about it kind of the two pillars of that from a high, like an early stage company, where it's the LTV CAC and how efficient am I in bringing on new business. And to Daria's point, I think there's kind of a reset in expectations now, whereas in the past it was always something that would be figured out in the future, and you know, there would be essentially a go get, whether it's a year or 2 years down the line, and in the interim it's okay if unit economics on a customer level don't make sense. I think kind of the message has been broadcast pretty far and wide that everybody in the organization really understands efficiencies are needed, and to be an attractive business and to not just grow at all costs, you can still have a really attractive business that doesn't have the same rate of growth if you're doing it efficiently. And so I think the other kind of pillar, if you will, is just around gross margin improvement. And so I think similarly, it kind of relates to how are you growing? Are you growing in the right way? There's how do I acquire and how do I, you know, price and really optimize, you know, the top part of my P&L, and really thinking about, again, how can I scale up so that the next dollar that comes in is that much more attractive versus just focusing on, you know, the what's right now in the rear view of I can grow, I can get a great multiple on my revenue, and the rest will be figured out. I think there's a lot more focus, and we're really seeing that in our portfolio of SaaS companies, that there's this focus on both the gross margin profile as well as that cost of acquisition.
Yeah, I think you could also learn a lot from bootstrap founders here. So I also think that every VC-funded SaaS company should have at least one bootstrap founder on the cap table, just because these people have a completely different view on like the P&L and the KPIs and how to grow sustainable. And I mean, given the current trends, metrics like Rule of 40, sales efficiency, etc., are becoming more important. I mean, I've looked at some companies, they've burned through a pre-seed investment of 10 million within just a year or so. Heavy burn, but didn't get anywhere. So it's like still low traction. And so now it's more about, yeah, trying to find product market fit in an efficient way and then scale from there and pour more money on the channels that work, rather than, yeah, spending millions on testing hypotheses that don't work out. And so, I mean, if you talk to bootstrappers, they have to grow revenue and then they can hire a new person, or spend more on sales and marketing. And I think a bit of that mentality should also, find a place in the VC funded world.
Yeah. It'll be interesting to see how that develops, particularly over the next couple of months as budgets become a little tighter as well, and people need to prioritize, don't they? Yeah. Okay, so maybe an impossible question to answer, but Dirk, I'm interested if there is sort of an optimal runway or time that people should be focusing on right now, or preparing for.
Yeah, I mean, you should take my advice with a grain of salt, because I'm mainly focusing on bootstrap founders. But I would say you should at least have 18 months, rather maybe 24 plus months to be on the safe side. But I would say, yeah, 18 months is a good benchmark.
Yeah.
So what should you do if, let's say, you're a founder, you raised a seed round, let's say 9 months ago, you have 9 months in the bank and you're not quite there to raise a Series A? Like, what should you do? You're in the position you're in.
I would say consider other options than raising a follow-on round, because depending on how much traction you will have at the end of your runway, it will get quite difficult. And again, in the last 6 months, I've talked to so many founders that struggled to raise a follow-on round and came to us last minute, so just before filing for bankruptcy, and then it's definitely too late. So yeah, if you think, okay, maybe revenue-based financing could be an option, or maybe venture debt could be an option, or raising a down round maybe also. You should consider it, because at the end of the day, keeping your company alive is number one priority. I think that's what I would answer.
Yeah, and shameless plug, because you teed me up there, Dirk, but I think that's what we often look at. Is we look at companies that are put in that hard place of they got good metrics. They are in this environment where a lot of folks are telling them to keep quite a bit of runway on their balance sheet, but naturally, early stage, you're going to be burning. And that's where, us and players in the space are really excel, is to be able to provide companies that additional runway, in this environment where they can then kind of prove it out. And I think, one other thing that I would say, just outside of simply always having that cash, is having a path to it. It's always having a backup plan. And so, that's one exercise that we always go through, is not just knowing what is my runway if I keep running the business as it is today, but as we've seen in the last 9 months, macro environments can certainly change, funding environments can change. So knowing across your business, what are the actions that you can take to potentially mitigate any of that and to help the runway, even if you're not ready to pull it yet.
Yeah. And maybe that kind of flows nicely into the next question I have, which may be for you, Jonah, which is on some of that cost sort of optimization, sort of capital optimization, sorry. So when you are figuring out where you're going to spend your money, sort of how you're making some of those hard decisions. And probably more importantly, we see a lot of people obviously going through layoffs, but there also might be sort of other changes to your existing employees when it comes to the incentives that they're working towards for next year as well. So how do you work through all of that? How do you make those tough decisions?
Yeah, so I think in terms of the tough decisions, it all starts from transparency. And what I mean by that is the worst thing that could happen is if we make these tough decisions and folks really don't understand why. That's not fair to anybody. That's not fair to us, from the leadership perspective, planning the business, to employees. Everybody should really be along for the ride and understand what constitutes good performance. And so I think, from the onset, how do we set goals that make sure align with what we need to from both the market environment as well as company performance, hit to how you judge performance, so that when you can then take actions, they are validated and you're as objective as possible. So for us, and we've gone through a number of different iterations, for instance, the OKR process of setting that enables us to really think about how can we judge performance. And then incentives, similarly, I think that transparency, the part that I'll kind of tag onto that is just constant communication. So making sure that incentives are aligned. By the earlier you are, to be honest, the more you're likely to get it wrong in terms of if you just set something and have a hard and fast line on it, then that's probably not indicative of the changing nature of your business. So having regular cadence of touch points to understand, for example, go to market, and if I'm setting quotas, as Daria was talking about before, are these the right ones? What's really driving the business? What's important to the business? That it probably is not reasonable to have a semi-annual or annual plan at this stage of a company, but what's your monthly touch point to reassess and to make sure that everybody's really aligned on what the true goals of the business are, so that if you're falling short, there are no surprises and you really feel confident in your decisions.
And maybe then to Daria, because transparency clearly is kind of a big part of what you're saying there, Jonah, and having sort of clear line between what success looks like and what it doesn't. But Daria, when you're making those kind of decisions, again, whether it's about sort of, changing the makeup of a team or even changing sort of, comp plans and stuff like that, how do you make those changes without it impacting the team culture so much, especially, with a small and fast growing team, right? Where you need everyone to stay focused on the bigger picture.
So we made a decision pretty much on day one that we're going to be like 100%. And by that, I mean, everyone in the company can see everything, apart from certain HR things, but everyone in the company knows how much money we have, how much runway we have left. And it's a bit of a dangerous game to play. Apparently, I don't know, I'm paraphrasing, I've never seen it, but Netflix have this deck, because they're also a very transparent company, that says, if you share those numbers and you make money from it, you will go to jail if you share those numbers and don't make money from it, you are an idiot and you will get fired. So in the same way, we kind of trust our people, and it's, you can't bring someone right out of college and put them on a team like that and expect them to know what to do. Like the hard work is making sure that when people open something and see that the company has 6 months of runway, they don't get paralyzed with fear, right? So you need to, there's a big investment to be made in educating and making sure people can interpret those numbers. But it starts there. It starts from everyone in the company understanding like where the company is at, how decisions are made, which numbers everyone is looking at. And the second is, I believe in ownership. Like everyone in Salesroom has equity in Salesroom, and people understand that, you know, no one ever got rich on salary alone. So people who pick that path, they are here for the equity, and the performance of the company is kind of directly tied to the performance of their equity. So it's making sure really people think like owners, and that's how they understand why certain decisions are made.
Yeah, precisely. And so then, you know, maybe just around kind of having them think of owners, we've got a question here from Eddie, who's asking about goal evaluation. And so I think, you know, obviously thinking about this from your seats as sort of the leaders of these companies, but also from that kind of individual contributor owner perspective. How are you all evaluating goals in terms of cadence? Is it a weekly, monthly, quarterly type thing? And then, you know, have there been situations, or do you think there's going to be situations where you may need to reevaluate those goals, raise them or lower them, just based on, you know, some of the stuff that's happening out there in the market? Who wants to jump in on that one?
Yeah, so I
go for it, Dirk.
Yeah, so I can maybe start. I mean, for us, it's a bit different because we just closed our 12th acquisition. So we have now 12 brands. I think evaluating goals on a weekly basis or monthly basis simply wouldn't be possible with such a high amount of different companies and products. So we have quarterly feedback calls with the brand leaders to see what worked out, what did not. Because always when we acquire new companies, we are trying to define maybe top 3, top 5 projects to work on together. Some hypothesis we have in terms of growth or bottom line optimization, whatever it is, feature development, and then on a quarterly basis, we have a longer discussion, trying to adjust if needed, and that works out quite well for us.
Yeah, I kind of alluded a little to it earlier in terms of our OKR process, but how we go about it is there's a planning process which we do quarterly, and then we have formal touch points every month. And you know, this is amongst a larger group which is split up into the kind of key focus areas, and those focus areas meet on some regular basis just in terms of hitting their goals. So some might do bi-weekly, some might have more frequent. And then the really important thing in the background is we really try to make sure that everything is trackable via data, via dashboards, whatever it might be, so that, you know, while it's not necessarily making it overly bureaucratic of what is the formal touch points, it's something that if anybody in the company had a question of how are we performing towards X goal, there is a resource to be able to look and get leading indicators. Because for us, I think that really kind of spurs some ideas and might, you know, start a different sprint group towards that.
Yeah, it's interesting, like tying that to the concept of sort of ownership and transparency, right? If folks are able to see what's actually working, what's not working, then obviously they're in a better position to be able to do something about it. But also I appreciate what you're saying, Dirk, around sort of, you know, there is such a thing as too much. And so probably figuring out what's the right balance for your organization based on capacity. Let's not get lost in weekly reporting if it's unnecessary, and instead focus on, you know, the top 3 things and ruthlessly aim for those. Yeah.
I mean, you can still have a higher cadence, what we talked about previously, with your direct employees within the team, but talking with the brand leaders to set like overall goals, I think it's not needed to have that on a weekly basis or even bi-weekly basis. So quarterly is sufficient, I think.
Yeah. So we're going to shift it a little bit, and we're going to focus more on sort of the positive side of growth, I guess, in terms of what are we really trying to focus on, what are we investing in, But there's a quick question for Dirk that I think we're probably all interested in the answer of, which is also quite positive. Dirk, what type of bootstrapped SaaS businesses are you excited for in 2023 that you haven't been so focused on in the past?
Yeah, it's pretty much aligned with what I told about our portfolio brands, that we are looking for more enterprisey customers, and same also applies to the M&A side. So we shied away from enterprise SaaS so far, to be honest, because we haven't had the sales expertise in-house, and because we wanted to not create too much overhead. So we have very small teams that are very product focused, that usually don't have a sales team, maybe 1 or 2 people. Yeah, that's why the focus next year will also be on acquiring more mission critical businesses with higher NDR, which is, to be honest, hard to find in the bootstrapped world, below 5 million or below 10 million, where our focus is, but they exist. And yeah, that's a change in focus.
Yeah. Interesting. We'll all be watching for the press releases.
Yeah, and I mean, we just closed the first transaction, which fits into that bucket, Cross Talent, which is a Salesforce-based HR tool. And they are definitely more enterprisey than our usual SaaS Group family member.
Yeah. Interesting. So then let's stick with the positive, what are we investing into frame of mind. And again, a question to the panel, maybe starting with you, Daria, sort of what are some of those investments or big bets that you're making at Salesroom for next year to really drive growth?
So one, we're always investing in product. Our team is 70% engineers, so video is hard, and to our customers expect a certain quality bar, which is very hard to maintain without that investment. The other 2 areas, one is onboarding experience. Nothing pains me more than kind of bug reports and questions from customers when they can't find something easily, and when we can make things even more intuitive. And thinking about our user, those are not the most tech friendly crowd. So investing into making the product really like as easy as, I don't know, using TikTok or Instagram. And the second area is investing in brand. I think a lot of companies neglect that because it's, I mean, Rachel, you know the code better than me, like 50% of my marketing spend is wasted. I just don't know which 50%. So brand investments are very hard to track, but I believe, and that's why I think a lot of companies neglect them, because in the world where you have to account for every dollar, it's difficult. But in the end of the day, if your company doesn't have a story, and your go-to-market team doesn't know how to communicate that story, I believe it's going to be incredibly hard to win customers next year and beyond.
Jonah, what about you?
Yeah, I think quite similar. We're always investing in product and tech. I think we look at Capchase as, we started with financing, but there's many more ways that we continue to look to serve our customers. And as mentioned a bit earlier, in terms of the data we collect and what our value prop is of really understanding a business and being able to serve them up capital along their growth life cycle. So too, can we then better understand what are other ways that we can both build our existing platform to make ease of use better for customers, but also what are the other potential features that customers may want. And so we're always trying to identify those pain points and then build around that. And so that's an area where even in this environment, we look to continue to invest because we think it's always worth it. Other than that, I think one area is just kind of top of funnel and really making sure that we invest to get our conversion really scalable. And so I definitely agree. We're investing in brand as well as we think about, what are the sorts of partnerships out there that really make sense for us, that fit our ideal customer profile. And then when you identify those and are able to really see them start to kind of pay off, to double down there and to really invest further.
Yeah. the dream scenario, isn't it? Where you sort of stumble upon something, double down, and can grow that really nicely. Actually, on the topic of top of funnel, we have a question here from Alexander about inbound versus outbound. So, probably more focused on you, Daria, Jonah, Dirk. I'm sure you've got something to add here as well. But so the question is, what's the trend looking like for next year when it comes to inbound versus outbound? Is outbound still the way to go initially? Are there tools that can help scaling the efficiency of outbound? I'm sure there are, but who wants to jump in on this one?
I love this question. Alexander, how many hours do you have? Okay, I'll try to keep this brief. I think going beyond this, climate and whatever, if you look at this classic outbound predictable revenue playbook, people probably started doing it like 7-8 years ago. Since then, we got between 10 more mass emailing tools, like think Outreach, Salesloft, Apollo. Like if you think about it, with Apollo, and I'm not advertising, which is something that I use, for $99 a month, you can send as many emails as you want, right? On top of it, people now, I think where I'm leading is the outbound playbook is becoming very, very saturated. Because I don't know about you guys, but I think there's a stat like every decision maker gets about 120 emails a day, which is crazy, right? So from my perspective is, I think if inbound is working for you, that's great. And you should double down on it. If you have cracked how to get those leads inbound, it's an excellent place to be. Now, inbound doesn't lead forever. Can you build a massive company without having any outbound? Some do it. I think Notion is the best example of that, but they also have the product to support that. And I think they invest a hell of a lot of money in brand and brand experiences. So I think when you think, I would put that question differently and say, hey, how can we make sure that per each amount of effort, we're getting the most output? And I think the place that's getting overlooked a lot is more that lead conversion piece, right? Because getting leads is going to be very difficult next year. Environment, saturation. Once you have that lead and you qualify that, how can you make sure that your salespeople are doing the utmost they can and that you're minimizing unforced errors? Like a customer showed up and your salesperson hasn't done the prep, or they're having a bad day, so they're talking too much, right? Or they're interrupting. So I think that you should continue kind of to do both, whatever is working for you, but shift your emphasis on making sure that that conversion rate is as high as it can possibly be.
Yeah, I really love those points. And I think the one thing I would just add on to that, where I'd say we're kind of the early months challenges of the business, is getting the infrastructure in place to track it, so then know where are the leads even truly coming from? Like, what is the first touch point? How can we be certain about where the investment dollars are actually making a difference? Which is something I probably took for granted a little bit, to be honest, coming from larger companies to then at that early stage. It's the earlier you are, the more important it is to really get that in place, because it only gets more complicated. So I would butcher in terms of to the specific question of like which tools, but I know that our GTM team certainly took a large scan of the market to make sure that we got the right tools in place to get that attribution right.
Yeah, I would also add something, because you also mentioned in one comment, a second comment, that you're transitioning from B2C to B2B. So I don't know what your ACV is, but if you're just selling a $9 monthly subscription or so, it might not make sense to tackle your customers or contact your customers with SDRs and account executives, because your sales process will never get profitable. So it also has to fit to your product, whether it makes sense to go outbound or focus on an inbound strategy.
Yeah. And then one other question from the audience as well is around sort of essentially what I would call sort of replanning. And we talked about it already a little bit before about what happens when you need to maybe change some of your goals, but I think also what happens when you need to change some of your strategies. So tying this to, you know, the context of inbound, outbound, or some of those brand investments that you're making, you know, how does that look like next year? What happens if you feel like you need to shift, or if something's not working and you need to move away from that? Like, how do you sort of manage that process?
Yeah, so sorry, go for it.
Sorry, go ahead. Yeah.
I think it comes back to the transparency that we were talking about before, where you know, the early stage companies, everybody is really kind of along for the ride. And similar to as Daria mentioned of everybody having equity, we follow the same approach at Capchase. And I think to look at all employees as really drivers as part of that, changing strategy is a natural part of an early stage business. And the more that you can kind of communicate that to folks, I think the more effective it will be. And another area where I think has been really helpful is making sure that you have the right, whether it's a formal board or investors, but just really folks that you can lean on that have done it in different ways before. They have different areas of expertise that you can really kind of suss out what is the right way to go about something and what are the alternatives, so that you can be a little bit more validated before you take the leap. And I think that's something that we've certainly benefited from and constructed our board accordingly.
Daria, what were you going to add?
Yeah, I was going to say we actually did change our plans about 6 months ago. Our initial hypothesis and product plan was to be completely kind of freemium PLG. So have a tool, you know, do a very heavy investment in content, salespeople sign up, start using it, us. And once we got to the point where we had like a stronghold within an org, we'd go to the head of sales and say, hey, your salespeople are using us. Don't you want to buy? And we found out that once the willingness to adopt tools on like an individual contributor level in sales is very low. Even in smaller companies, people are afraid to put something in front of their customer that, you know, their manager hasn't approved on. And two people kind of really stopped. The mind space kind of wasn't there. And so we gathered feedback for about a month. When we started having this sort of hunch, maybe it's not the right way to go. We started collecting kind of everything we heard and saw into this like very big Notion page. And then we sat down, me and my co-founder made that decision, ran that by the team, and kind of, you know, hey, this is what we've decided to do. Kind of showed the proof points of what we saw in the market that led us to that decision. And then the hard work was obviously to kind of change your roadmap and introduce more team features faster. So I think what I've learned from this is to sort of have certain fundamental beliefs, have that written down, but always be willing to question them. And have like knowing, okay, I believe this. What do I need to see in the real world to change my view on it? And when you set that before, it kind of hurts your ego a bit less. And then I think also the name of the game next year will be small bets, just because I don't think any one of us knows where we're going to be at this time next year.
Apart from all investing in Microsoft and Snowflake. Well, okay, one last question, just a quick fire round. So what's the, you know, 1, 2, 3 top line metrics that you're going to be looking at next year, following closely when it comes to growth? Have we all got the same answer, or are there different answers? Daria, you want to go first?
Yeah, mine is it's very sales focused. It's time to close for opportunities. I think time to close gives you so much insight into the health of your customer org, because on the one hand, it tells you, you know, like when you need to disqualify something, where you shift your priorities. And it also gives you like overall, if you look at the average of that, how well is your sales team doing? So I got strongly inspired by this one by Andy White, who's the founder of Medic. But that's my number one.
Great. Jonah, what about you?
Yeah, so I think number one for me is the lifetime expected unit economics per each customer. So kind of the next step from top line. But essentially, that kind of combines what is the revenue into the pricing that we're charging per customer, and what is our cost basis that's variable there, along with what is our underlying cost of customer acquisition. So that really guides us in all the major decisions that we make.
Yeah. Great. Dirk?
Yeah, I maybe have two, but they are combined. So it's net new ARR and sales efficiency. So net new ARR divided by S and M spend. So these would be my two.
Awesome. Combining the best of both worlds. Well, with that, we're going to wrap up for today. I do feel like we could probably go on for another hour or two. And for any of you who've asked questions or have more questions, especially around sales efficiency, I think feel free to reach out to any of these folks on LinkedIn and chat more about that. For now, thank you so much, Daria, Jonah, and Dirk. This has been a really great conversation, and thanks to everyone who joined us as well. As I mentioned, this is it in terms of our live panels at ChartMogul for this year. We'll be back in the new year talking about PLG versus product-led sales. And as I said, keep an eye out for that. For now, have a great end of year. We've still got a few weeks to go. Hope it goes well for everyone. Thank you. See you later and bye.